All righty. So, welcome to budgeting and planning for a restaurant's off season. My name is Chris Maxey. I'm the CEO of Prefix Accounting. We're a accounting firm that does payroll, bookkeeping, consulting, and advisory specifically for restaurants and food-based retail businesses. Today, we're going to be going over what it's like to navigate the winter months of, or the off-season months of a restaurant. Our objective here is that you're going to be able to take some tools, take a little bit of light math, and hopefully be able to do some numbers on the back of an envelope and put together an idea and a roadmap for what your winter or off season is going to be like, and how to plan accordingly so that you can make it through to the next season. So this is meant to be quite simple. It's not going in depth. We're not breaking out big pieces of software and forecasting and things like that. It's meant to be simple. It's meant to be DIY. And we're not going to go super in depth on any specific topic here. As a note, this is not legal or tax advice. I have to put this disclaimer in every single time, so I'll just breeze over this. Looking forward at the next couple of months, we do have a whole series that we have launched for this winter. All these webinars are geared around the winter months and what we will be, what you potentially would be focusing on in the winter months as you get ready for the next big season. So we have getting ready for tax, accounting for offsite events and catering, 1099s, strategies for lowering your labor cost, which we'll be touching on today, but we get much deeper in on that session. Accounting for a buyout, restaurant buyouts, and things like that. There's a number of different ways to do that. And we'll be diving deeper into that. As well as costing a menu, which is a big thing right now with inflation. So if any of those are of interest to you, we will send out the link afterwards. But you can, with the PowerPoint, but you can register for all of these events, and you can see when they are right through April. We'll have different webinars going on. These also will all be recorded, and they will be all uploaded to YouTube. So if you miss something and want to look back on it later, you'll get both the slide deck and the video of this uploaded to YouTube. If you want to get more tips or anything like that, and any future updates for any other webinars that we're doing, if you go to our website and sign up for our mailing list, you'll get an update every single time we post a new season of webinars. So today we're going to be going over what it's like to navigate the off season for a restaurant. Unless you're in an urban environment, you're likely looking at having a few months where you're making a lot of money, and then a few months where you're not making much money. I personally worked in a couple of restaurants where they only make the money that they need to in 1 to 2 months of the year, and then for the rest of the year it's pretty abysmal. But those 2 months are great. So navigating that and running a successful restaurant can get a little bit precarious, especially if you're in your first couple of years of operation. So we're splitting this up into basically 4 different segments. The first segment is going to be budgeting, looking at how to come up with what those costs are, what your fixed costs, variable costs, those sorts of things. Then looking at what our break-even is going to be, and then looking at a strategy to cut costs to be able to get to a break-even that's actually achievable in the winter months. Then we'll be looking at what strategies you can do for next year, since for a lot of rural restaurants, we're already getting towards the off season. But looking at what you can do next year to plan for the winter months. And then finally, we'll be going over some cash flow tips and tricks to help you extend to be able to help you get through these winter months if cash starts to get a little bit tight. So the first topic we're going to be going over is budgeting. With budgeting, there's two different things to consider here: variable and fixed costs. Your fixed costs are static. They never change depending on what the revenue is of the business. A lot of times, the most common example that we use is your insurance. Software costs are also one of those things, and rent. The thing to consider with fixed costs is that there are some things that are truly fixed. So your rent is going to be the same unless you're your own landlord. But there are other things that you might be able to cut back in winter months and aren't really a fixed cost at all. And then we also have our variable costs. And those are the costs that you have that scale with the amount of revenue that you do. So for instance, it's food, beverage, labor. You also might have a large takeout business. So consumable and disposable goods would be a good one. Your credit card processing fees, all of these things scale with the amount of revenue that your business does. So the first thing that I would do is I pull out a blank sheet of paper. I print out your profit and loss for the last month. And then on every single line item, put an F or a V next to it and look at what your fixed costs are, what your variable costs are, and then maybe a question mark for what things you're not really sure if they are or they aren't. The idea here is that we want to be able to segment out what your fixed costs are, because at the end of the day, that is going to impact what your break even is. If you have higher fixed costs, it'll be a higher break even. Same thing with variable costs. If you have your margins are out of control, that means the number that you have to hit for revenue is going to be a lot higher. So once you've isolated all of your fixed costs, total them up, and that's going to be your monthly fixed cost that is going to play a part later on in this. Next, you have your variable costs, and for all restaurants, there's three big ones. There's your food, your wine, liquor, and beer, or your beverage cost, and your labor cost. All of those fold up and are part of your prime cost, which some accountants might call gross margin. But for the restaurant industry, it's prime cost. You also have some things that aren't factored into this, but aren't anywhere near as big a component of your costs, such as, like I said, consumable costs or credit card processing. If your business is largely takeout, that might be the case, but it's smaller in the grand scheme of things. So essentially, what we want to look at here is what your costs in terms of percentage of revenue are. So when you hear the term food cost, beverage cost, labor cost, whenever we're talking about those things, we're talking about them as a percentage of revenue. And so with that percentage of revenue, we're looking at your food cost. So all of the things you spent on cost of goods for food through whoever your purveyors are, and then dividing it by your food revenue to give you your food cost. Now, I'm going to go into each one of these and kind of what the expectation is that they should be. Food costs, ideally anywhere between 26 and 32%, depending on what your menu is. If you have a lot of protein, that's going to be a lot higher than if you're a vegan restaurant, for example, which generally enjoys fairly low food cost. And the amount of production that you do in-house, some people call it a scratch kitchen, also positively affects your food costs because you're not buying things pre-made. If you're buying a lot of things pre-made, you're paying for somebody else to do that, and therefore your labor cost might be lower, but your food cost is going to be higher. For wine, liquor, and beer, generally these numbers are the same regardless of concept. It's going to be around 27, 20%, and 20% respectively for those three. And then finally, we have labor cost, which is 20 to 30%. like I said before, scratch kitchen, you're doing more production in-house. You're expecting a higher labor cost than a steakhouse where there isn't really necessarily any sort of labor inputs that are needed other than operation of the kitchen during hours of business. These three things roll up into prime cost. And the reason why accountants specifically look at prime cost is because it's the largest components of the cost of a restaurant. And more importantly, the prime cost is what is going to meet what a restaurant is going to, if a restaurant is hitting that prime cost target, it's likely they're going to be making money. Probably 7 or 8 times out of 10, if they're hitting prime cost on a regular basis, they're enjoying a positive bottom line. So we, as accountants, look at food, beverage, labor, group them all up together, and then divide them by your revenue to get this prime cost. And to me, this is the single most important metric for any restaurant. So what we've done here, essentially, is we've looked at what our fixed costs are. We've looked at what your variable costs are. We now want to know how much money you need to generate in a month in order to show at least break even. And for those of you that hated math, here's an actual use for y equals mx plus b. I know that most of us, probably when we were in high school, we're doing this, or we're in these classes and you're like, where the hell am I actually going to use this? Well, you finally found one example. So what we're going to be doing is we're going to be calculating what it is, or how to put those numbers together. So what we have right here is this y equals mx plus b formula. 0 is the break even, right? We want to hit $0 of profit. And then we have our prime cost, so that percentage that we looked at before. We have the amount of revenue that we need to generate, and then we have our fixed costs. So X is our break-even revenue number. So now I'm going to put this into an example. If you exceed that X number, it's going to be profit, as you can see in this graph here. But if we look at this in terms of a scenario, our budgeting scenario is that your fixed costs are $25,000 a month. Your prime cost is 55%. So what is the break even? This is the entire amount of math that I'm going to have you do. So I apologize for this ahead of time. But what we are looking at is putting the prime cost 0.55 for 55%, $25,000 for the break even. And we're going to actually solve for X. And you subtract the 25,000, bring it to the other side, you divide the 25,000 by the 0.55, and it's going to give you this $45,000 number. So it's simply a matter of just changing these two metrics here, and it's going to give you, allow you to solve for X. So in this case, it's $45,000. So for this restaurant to be successful, they need to generate $45,000 in revenue per month in order to at least hit 0. If we look at this on a weekly basis, like most restaurateurs do, we're going to divide that number, the 45,000, by 4.3, which is the average number of weeks in a month. Fun fact, it's not 4, it's 4.3. And that'll give us our weekly take. So this restaurant needs to generate $10,500 per week in order to hit that target. So for a lot of us, what we're going to do right now is, after we've solved this and we've found what our break even is, we're going to be saying to ourselves, oh shit, that number is way too high, so that there's no way I can generate that amount of revenue in the winter months. Or it's going to say, you're going to say, okay, that seems reasonable. If your answer is, oh shit, that number is way too high, then what we have to do is we have to change this formula and figure out a way to lower our break-even point to a lower point so that we can generate money through the winter. And I'm sorry ahead of time if your low season isn't in the winter. I'm just in the Northeast, so for most of us, that's when, you know, winter is the slow period, or stick season if you're a skier. So what we want to do here is we want to change those numbers. We either want to change the fixed cost and lower the fixed cost, or we want to lower our prime cost. Your prime cost may be nowhere near what this target number is. So if this number essentially is, your prime cost number is more than 55%, say it's 80%, and our break-even's the same, or our fixed cost is the same, then we're going to be, we're going to be looking at a much higher number for a break-even in order to make money for the winter. So if you're at 80% prime cost, your break-even number is going to be 3 times that amount, which is why prime cost is so important. So looking at changing that prime cost and cutting your variable costs is what's going to dramatically impact your break-even. You can change your fixed costs on a monthly basis, but it's likely that you're not going to be changing it that much. So realistically, a lot of your savings and a lot of the way that you're going to, the way that you're going to get around surviving this winter is going to be related to controlling your fixed cost or your variable costs. So let's take a look at how we can do that. Going back to our earlier slide, we have food cost, we have beverage cost, we have labor cost. Your calculations of these margins may be dramatically different than what I have here. Usually it's higher. So if your food cost is higher, or your beverage cost is higher, or your labor cost is higher, you need to adjust that and bring that number down so that your prime cost is 55%. So why prime cost is so important to me is because regardless of whether you're a steakhouse or you're doing smash burgers and takeout, right? That 55% is still true, because labor might be a little higher for one concept, food cost might be a little lower for another, but all at the end of the day, regardless of what the concept is, the 55% is where you need to be. So if you're looking at these 3 costs and you're averaging it out and your prime cost is higher than that, you need to figure out which of those 3 is contributing to that number being higher. So whether it's food cost, wine, beer, labor, those are the little levers that we need to pull in order to make sure that we hit the end target of 55%. For a restaurant that is looking to reduce food cost, there's a couple of different options that you can go with. The easiest is to reduce menu size. These large menus where you have, 35, 40 items on the menu, those are long since dead, and with prices changing so frequently, there's no way to actually calculate out your food cost on a weekly basis or monthly basis. It's just too much of a bear with everything changing so much. So one of the things that you can do is you can reduce your menu size. That will aid you in having less things to order, a smaller amount of inventory, and that inventory is turning over much faster. So moving from a 35 item menu down to an 18 or a 20 item menu, or even in some cases, there are some restaurants that have like a 15 item menu, is a lot more useful, specifically in those winter months. One of the other things that you can do is you can look at making your menu less protein based. One of the largest components for any restaurant is going to be protein cost. We've seen in the last 3 years, chicken wings, pork belly, brisket, like all of these different components change in price wildly in price. And most of those things have been protein based. Vegetables and dry goods have, for the most part, stayed relatively stable in comparison. They have changed some, but for the most part, it stayed relatively stable. So both for ease on yourself and also for better food cost, if your menu is more vegetarian based, you have more vegetable based dishes, your food cost is going to be significantly better. You have to price it, and you have to check and review your invoices each week to make sure that those prices aren't changing on you, even if it is mostly vegetarian or vegetable-based foods. One of the things that is coming down the road is with the conflict in Ukraine, they produce a significant amount of fertilizer, and they produce quite a bit of produce. This conflict is going to have lasting effects on the restaurant industry because a lot of those proteins and vegetables are based off of fertilizer prices. So if the world supply of fertilizer, I can't believe we're having this conversation, but if the world supply of fertilizer drops, then food cost is going to increase and menu prices will increase as well. So it's important that regardless of what the component is that's in your menu, you're reviewing those components to see what the change in price is. That brings me to my next point, developing a more profitable menu items. If you're looking at your menu and you're saying, okay, these prices are, my food cost in concept is good, but I have a few things that are higher food cost, and I think that's what's contributing to my number being higher. Well, the way to do that is not to remove the higher food cost item that sells really well. It's to pair it with something that is a low food cost that is also going to sell well. So this is a challenge for your chef to come up with menu items that are low cost and also can sell a lot, that can offset higher cost items. If you have a tomahawk steak on the menu, you realistically aren't going to be able to hit 28% food cost because you just can't price that steak at that amount. So you need to have a pasta dish or salad or something that is relatively low cost to offset that. If still, after those items have been addressed, your food cost is still too high, then it comes down to yield and portioning being the culprit. A lot of times you can use tools in place to make sure that yields are the same. For example, their fryer oil for a period of time was quite expensive. People and portioning for maybe fries and a burger, your cooks were putting too many fries on the plate. Well, shrink the size of the plate, physically shrink the size of the plate, so then they can't continue to put that many fries on the plate. And checking to make sure that your yield and your proportioning of those items are accurate, because you might think it's only 2 ounces of cheese when it's really 4, and that has a pretty profound impact. The last item that you can do is you can increase prices. The reality of it is that with inflation going up 2 to 3% a quarter, your menu prices should be going up with that. That's the unfortunate reality of it. You can only do so much here in these earlier steps before you still have to reduce prices anyways. And everybody else has been increasing food price, their prices of their goods that they're selling. Restaurants are have the hardest time with changing prices, but the reality of it is that you have to. So You can change the portioning, you can change the menu, you can have more vegetable-based components, but at the end of the day, you still may have to increase prices. And you should increase prices. You have to do it with the amount of inflation that there is this year and probably next year. You need to regularly be increasing prices here and there, not completely dramatically changing your menu all at one point and changing all the prices, but here and there, changing the prices, increasing them to get your average up throughout the month. We are going to be doing another webinar, like I said earlier on, that is going to delve deeper into controlling food cost and strategies to reduce your food cost and hit that target number, because you could go on about this forever. But at the end of the day, 28% is a pretty good target for most restaurants to hit for food cost. For beverage, we have a couple of different components, and actually we have more than this, but these are just the big three. Wine, beer, liquor are the three. You also have cider, non-alcoholic beverage, and some other items that are lumped in with this as well, non-alcoholic beverage like coffee. But these are the main three. If you're off your 27 or 20% margin, here are the ways to reduce those costs. You can reduce your bottle list for wine, alter your pour size. You might be doing 4 pours per bottle. Maybe look at doing 5. Use a tool for accurate pours if you have younger staff or untrained staff. I've seen a lot of restaurants that just have a line on the bar that's right by where they pour the wine. That's that check, so that they can continue to use that and rely on that until they have enough skill to do it themselves. Check prices on all the bottles. The bottle price should be the price of the glass. So if you're paying $10 for the bottle, you should be charging $10 for the glass. And most times now you might want to scotch that up another $1. Beer is at 20%. For a lot of fine dining, beer is always a continuous issue because you might not sell enough of it. The lion's share of your sales might be wine and liquor. Most times with beer, it's inventory turnover. You buy a couple of kegs, you don't move those kegs fast enough, and then you have either poor pours or you have poor yields. You don't sell all of it, you have to give it back. The reality of it is it's the same solution as with food cost, that with beer, you really want to probably narrow the amount of beers that you have on tap down in the off season, so that you're moving through that inventory faster and you're only buying that amount, so you're not carrying this huge broad inventory of beer. And then also consider logs and smaller or bottles, especially if it does get very slow, just because a keg, once you tap that keg, it does have an expiration date. And so be leery about bringing in a keg when it's your off season. You might not get the same value that you do with a keg with a log, but at the end of the day, if you don't sell that keg, well, really, was there that much value there? One of the things that I think is really crucial with beer is it's okay to run out. Like if you run out, like if you bring in limited production beers that people seek out, and you run out of it, that's fine. That's good. Pull it off of the menu, pull the tap. That's fine. You don't constantly have to have that inventory in place unless it's one or two of your staple beers. Move through a rotation of it. And then finally, with liquor, if everything's priced properly, and your liquor cost is high, a lot of times it comes down to pour and staff drinks being the common cost issues. because it's such a small amount, because it's such a small amount of beverage that you're pouring with every single bottle, your costs over the course of the bottle being sold average out. So if your cost is too high with liquor, it's likely because somebody is systemically pouring too much from what the menu's priced. So regularly check menus and recipes to make sure that everything is good there. And then finally, non-alcoholic beverage and mocktails are a huge area of expansion for restaurants. And if you don't have that on the menu, add it, because you're charging nearly the same amount that you would for a regular mixed cocktail. Not quite as much, but you have great margins on it. And so adding that will definitely help to reduce your beverage cost. Also, if you do have any questions throughout this presentation, at the bottom you should see an option for any sort of questions to be asked. Go ahead and ask those questions, and then at the end of the webinar I will answer any questions that pop up. The last item that we have here is for labor cost. Winter months or off-season months, it's really about reduction of your hours and days that you're open. Through your normal season, through the busy season, you're trying to cast the widest net as possible. Through the winter months, really what you're looking to do is you're trying to concentrate as much business in as few hours as humanly possible, so that you can keep your staffing as low as possible. So also with this, and with the food cost item, a reduced menu also helps to reduce your labor cost. So you can operate within 4 to 5 days in a 4 to 5 days in a week, as opposed to 6 or 7. Most of us have made that move already, where, you know, a restaurant open 7 days a week is kind of the rarity. It is also worth looking at to look at maybe doing a 4-day menu, or a 4-day week, or looking to change one day to be an alternative menu. So something that somebody might seek out, something that is it's very easy for you to do with a very light staff. And so looking at reducing the hours of your business, maybe getting rid of brunch in the winter, reducing your late night, close a little bit earlier, is a good strategy for lowering your labor cost. If you're having trouble hitting your revenue targets, you might actually want to do the opposite and expand hours. So it's a lever that can be pulled both ways. If you're looking to reduce cost, you're going to be reducing hours and days. If you're looking to increase revenue, you might be looking at expanding hours. The other thing to consider with this is that a lot of restaurants right now are operating on a 5-day model. And for the most part, many restaurants are doing Thursday through Sunday. If all restaurants are open on Thursday through Sunday, who is open on Monday, Tuesday, and Wednesday? So what you should do with this, and as you're carefully adjusting your hours for the winter month, also go out and look at what your competition is doing and what days they're open. And if nobody is open on Tuesday, which I guarantee you right now, nobody's open on Tuesday, maybe that's the day that you open and you have that alternative menu. That you have a skeleton crew on, where you're bringing in a few extra $1,000 that's very low and that isn't requiring a huge amount from you. The other component that we have is considering a kitchen service fee. So this is separate from your tip pool. Your tip pool is completely separate from your your tip pool is completely separate from this kitchen service fee. They do not interact at all. They're separate. Said again, they're separate. No mixing. You can add this to your check with some point of sales where you can add like a 3% service fee for the kitchen. You have to be careful with this. There are some markets where you can do this and no one will say anything. And there are other markets where customers might be a little bit more price focused, where this will not fly. And every single Yelp review that you get will mention this service fee. It is a good way to help to offset labor costs, specifically in the back of house, which is the largest burden for you. You have to tread carefully here. And also, if you are going to implement this service fee, definitely make sure that you check with your lawyer to make sure that it's okay in your state. And B, also to make sure that you have it illustrated in your handbook, how this works, who qualifies, who doesn't, how it's broken down, all of these sorts of things, so that you don't run into any sort of class action lawsuit about a kitchen service fee. So it's critically important to check on this. It's one of the most common tip pooling, and service fees and things like that are one of the easiest ways to get sued if you don't have everything buttoned up. So definitely make sure you check with your lawyer before you implement it, and be careful with implementing it in certain markets. So essentially what we've done now is we've looked at what the break even is, how to modify what your target numbers should be, how to modify those target numbers so that they come down to a realistic break-even point for you. So you have that number now in your head, and you can use that for this winter as you get through this winter. The next thing to do is to look at what next winter or next off season has in store for you. And that means planning for the future. So one of the most important things that we do at Prefix is we look at what your nest egg should be for the off season. Most of our restaurants are in rural environments. We do have some in the city, but the lion's share we have are in rural environments. So we're focusing throughout the summer on looking to see whether or not our clients have enough money put away so that they can burn it through the winter months. So the secret to that is the financial statement that no one ever looks at, which is the statement of cash flows. So we'll look at that in the next slide, but it looks at how much money you spent regardless of what the profit and loss is. A lot of questions that we frequently get is in the off season, should I close? And if I close, how long should I close? The answer to that is that from an accounting perspective, I want to say 90% of the time, the answer is no, you shouldn't close. But from a people perspective, probably you should close. If it's the worst weeks of the year, that's a good time to close up shop, let everybody decompress, go away, come back. But just know that if you do close, there is a cost associated with it. You are not going to be, it is not going to be more beneficial for you to close than to stay open. It's just the costs and the fixed costs that you have as a restaurant, your break even is going to be way too high to be able to hit that number and still close for 3 weeks of the month. You can also look at minimizing your fixed costs, but for the most part, a lot of the fixed costs associated with a restaurant are fixed, and there isn't really a lot that you can do about it. There are a couple of things that you can do, specifically with like insurance and timing. So looking at when you have these big annualized expenses and figuring out when it is that you can do that is not in your low season. A lot of folks renew their general liability insurance or their liquor liability insurance in the winter months, because that's when they have the time to do it. But then they have to put a 25% down payment on their policy, or they pay the entire policy in the winter months. And that timing is not useful when you don't have enough cash coming in to cover it. So talking with your insurance broker and lining it up so that you're putting your 25% down payment down in a period of the year that isn't going to have a significant financial impact on you, and then splitting it up so you can do a 25% and 9, they call it, breaking that up throughout the year so that you're not paying this huge lump sum in 1 month. There are other annualized expenses that you're probably thinking of right now that also you can look to see if you can do that sort of agreement. There's a lot of financing companies out there that will assist you in breaking up those large annualized expenses into months. And then finally, the last big thing is strategically paying yourself and your investors. You may have an operating agreement that talks about paying out investors on a quarterly basis. You should consider, if you have not yet opened, you should consider looking at that and whether or not you want to time that better, so that you aren't doing a distribution in March when you're already on fumes. And then generally, for most restaurants that we deal with, you have your high season, you have your low season. Generally, what we suggest is if you're going to pay yourself and you aren't, already on payroll, pay yourself at the end of the summer when you know how much money you need to have. You have a little bit extra, take it then. And then at the end of the winter, if there's some money left over and you're going back into the busy season, that's the other time of the year to take it. Other times outside of that, wouldn't advise it. So, statement of cash flows. If you have an accountant and you regularly get financial statements, which you should on a monthly basis, if you're regularly getting your financial statements, you're likely going to be getting a statement of cash flows, a balance sheet, a profit and loss, maybe an AP and AR aging report. Usually, most of us flip right over, look at the profit and loss, see the bottom line and say, okay, well, we made money or we didn't. And that's the end of it. Realistically, what you should be looking at as a restaurant is this very complicated financial document, the statement of cash flows. It tells you where at the end of the month, you have a net income. You might have a $5,000 bottom line for the month. You have lost money from last month. You look at your balance sheet, the money that you had last month decreased from where you are today, or where you were last month. And you're like, well, how the hell is that possible? Where did that money go? This document tells you what that is. It ties out what your net income was and all of the other things that affected your bank balance that wasn't on your profit and loss. So for a lot of people, it could be payroll timing. You could have payroll tips. It could be that you have a bunch of events that event deposits you took in. You could have bought a piece of furniture. There's a lot of things that happen in a restaurant that don't show up on a profit and loss. So the important thing to do is to look at your statement of cash flows. If you have an accountant, have them send you a statement of cash flows by month for the whole year. And then you can look at, and you can see what months you had an increase or a decrease in your cash on hand. If you had, in those months, which are usually the low season, you'll see the negative amounts where the cash for the period dropped. What you want to do is you want to look and see where you had investing activities. That's where you buy usually pieces of equipment or furniture or something like that. You want to pull that out because that's probably not recurring. And you want to look at, in those winter months, what does that number add up to? You might have a $10,000 decrease in cash one month, a 15 the next, a 20 the next. You add those months up and you can see what the total cash burn, as accountants call it, is for your slow period. Add those up, it'll give you a number. We'll just say it's $50,000 in this case. What we're going to do then is, for the next year, we're trying to build up $50,000 worth of cash, so that if your season ends in basically at the end of October, you want to have $50,000 in cash set aside, so that for the next couple of months, you have cash sitting there that you will knowingly burn away, but then you don't have to put money into the business. Where if you've been open for a few years, you frequently come into this problem where in March, you're asking your investors, hey, I need more money. This, by just doing this once per year, at the beginning of your year, and having that goal in your head, and then achieving that and having that money put aside and not distributing it out to investors, that will create a scenario in which you're not like up in the middle of the night in February wondering if you're going to hit payroll this month. So again, I'll reiterate, take a statement of cash flows, look at it over the course of the year, have it for a statement of cash flows by month for the entire year. You may want to look at the previous year and compare the two, and then look at what that number, that negative number, is in those months that really are not profitable months for you, are the slow months for you. Also, if you're planning on doing any work in the off season, like you might be looking to put in new refrigeration, you might be looking to make some modifications to your air conditioning or something like that, add that number on top of your $50,000, your nest egg, and then that is your goal. And also, you should be having your conversations with your investors about making sure that you have that liquidity and that free cash flow available, because a lot of times what happens is at the end of Q3, your investors are like, well, we have $150,000 in the bank, we should distribute all of that. Well, not really, because you're just going to put it back in Q1 of the next year. So that is a statement of cash flows and how it's useful to restaurateurs. Finally, cash flow tips and tricks. Here's a couple of little things that you can do throughout the year to set yourself up for success later on. The first thing that we do, and what we generally encourage all of our restaurants to do, is to have separate bank accounts for different functions. We're normally looking for 3 different bank accounts. Your operating account, which is where your deposits go in, your credit card deposits go in, your cash deposits, and then all of your bill payments come out of. That's where a lot of the activity happens. The next is to have a payroll account, which is just for your payroll. Then finally, your tax, which is for your sales taxes. The reason we separate this out is because it makes it a lot easier for you to see the cash flow happen without taxes and payroll factored into it, right? So when you run payroll each week, you run it and it debits out of the payroll bank account. Once you hit submit on your payroll, you see what the cash required is, and then you move that money from your operating account to your payroll account. Now you don't have to worry about whether or not you're going to make payroll or not. You move the money over, it's done. Same thing with sales tax. What generally happens is people collect a lot of taxes throughout the month. It's not your money, it's the state's money. And then they hit the 20th of the month, which for Massachusetts and a lot of other states and Vermont, that's the day that the sales tax is due. They suddenly realize, I have $20,000 in my bank account. Oh, 18,000 of that is sales tax. I now have $2,000 left available. The way to save yourself from doing that is each week looking at your point of sale, looking at how much sales tax you collected in the previous week, and then transfer that money into the tax account. That money doesn't get touched. So that way, when the 20th comes, it's not even a thought to you. You already have that pushed off to the side. It's in your payroll tax, or it's in your tax account. You don't have to worry about it. It's coming out of the account. It's not a thought. Finally, some people might want to put a reserve in there. If your goal is to have $50,000 pushed aside for the year, set up a reserve account and generally move money over there as it's available to stash away for the winter or for any large projects that you might have. Finally, use credit cards and line of credits only as a last resort. It's always better to have that cash nest egg put away and available for you so that you can use that later on rather than using credit cards or line of credit and paying astronomical amounts of interest on it. Pay yourselves and your partners carefully. Like I said before, end of the busy season, end of the low season. Pay vendors on term. You may want to pay them immediately, but in the winter months, if you have net 30 on your invoices, pay them on net 30. And finally, don't pay personal expenses out of the business. That makes it very hard for you to be able to project out what your when you're going to run into a cash crisis. Pay yourself separately or through payroll if you are set up properly for it. And don't look at the business as a personal piggy bank, right? Take out the absolute minimum that you have to, and then at a couple of points in the year, end of high season, end of low season, take out any extra. Don't do it throughout the year as you see extra money available. The more you think of your business as your personal piggy bank, the more problems you are going to have. So, key takeaways: small, sleek menus, know your break-even point, have cash goals in mind for the winter or the off season, and then pay yourself last and carefully. Now we're going to switch over to some Q&A. So if you have any questions, feel free to submit it into the Q&A section, and we'll do our best to answer it. If we can't answer it, we will email you with the answer afterwards if we have to look at it. So feel free to go ahead and answer questions or ask any questions that you might have. Okay, so we had one question that was, I noticed when trying to tighten my inventory in quiet months, we were breaking cases when placing orders with distributors, i.e. a case of Hendrick's gin is $38 a bottle, only ordering 2 bottles because it was all we needed, but the cost jumped by almost $10 to break the case per bottle. I started encouraging my team to make 1 big order a month or cut down on distributors. That's a great question. The reality of it is that you're definitely going to be wanting to do that. You're going to want to order cases with anything that is certainly well, and that any of your commonly used liquors, like I imagine Hendrick's is going to be one of them for you, where you order the cases, and if you stagger it so that you're only ordering a few cases of things each month, then it shouldn't have too much of an impact on your liquor cost in aggregate over the course of the year. It comes down to how much inventory do you want to have and how much is the discount worth to you. And I'd say if it is $10, then that's a pretty large discount in terms of the price for breaking a case. To have basically a $10 surcharge that's quite a significant amount. So I would be ordering the cases. I would try to structure it in a way where you're only ordering a couple cases of select things each month and then kind of rotating it through. So like, you know, you might order a certain Hendrix one month and maybe a couple of tequilas the next, where you're doing that on case basis, and then move it, and then the next month vodka and things like that, and hopefully it'll work out in the aggregate, unless you do inventory each month. All righty. Not hearing any other questions. So if you have any further questions, if there's anything else that we didn't answer for you today, feel free to email us at hello@prefix.accountants. You will get to myself or my partner Lucy. And you can also find us on Instagram, Facebook. You can find me on Twitter as well. If there are if there's anything else that you'd like to ask offline, feel free to shoot an email there at hello@. We'd be happy to answer any questions you've had. You will also get an email from that email, if it's a little bit hard to spell out or hard to remember, with the slide deck and the link to the YouTube video. So you will be getting that later this week as well. So feel free to reach out and ask us for any questions, or if you're looking for an accountant, we'd be happy to discuss. Have a great day, everyone, and I will hopefully see you on the next webinar.